Welcome back to the Deep Dive, where we take these complex, massive stacks of information, the filings, the analyst notes, all the consultation papers.
Yeah.
We boil them down and give you the essential nuggets you need to be not just informed, but strategically informed.
Exactly.
Today, we are wading into a highly technical, really high-stakes battle that climaxed on January 6th, 2026. This was a confrontation between the traditional titans of global finance, specifically the index giant MSCI, and the pioneers of the corporate Bitcoin movement, Strategy, Inc.
It really was an institutional showdown for the ages, and what's so crucial to understand is that the resolution wasn't a clean victory or, a total defeat for anyone.
Right.
The market, I think, initially saw a headline victory, but the true outcome was more of a tactical truce, a heavily caveated agreement that, and this is the point, fundamentally changed the DNA of Strategy, Inc. overnight.
That's the absolute core of our deep dive today. We're talking about this unexpected regulatory clash between MSCI, that's Morgan Stanley Capital International, for anyone new to this, the firm that manages the benchmarks tracked by literally trillions of dollars in passive investment funds, and Strategy, Inc.
The company that pioneered and, really scaled the corporate Bitcoin treasury model.
And the central conflict here is profound. It's a question MSCI was forced to grapple with. At what point does a software company holding massive amounts of Bitcoin just stop being a software company?
Right. When does it become a de facto investment vehicle? That really was the regulatory trigger. And it carried a potential price tag of, $8.8 billion in forced outflows? Literally. Strategy had evolved so far past its original business intelligence identity that it had created this category of one problem for the index providers.
So that date, January 6, 2026, is pivotal.
Yeah.
The headline that flashed across the wire was that Strategy was retained in the major indices. But if you stop reading there, you miss the entire story.
You miss everything. The real significance lies in the structural constraint, this freeze that came along with that retention.
Okay, let's unpack this. Our mission today is to dive deep into the source material, the internal memos, the regulatory filings, the analyst commentary, to really analyze the technical details of this decision. We need to understand the freeze imposed on Strategy's common shares, MSTR. And most importantly, we need to discover how this severe external pressure is actually forcing the company onto a new, and I think we'll argue potentially stronger path. One focused on generating capital via digital credit, centered around their preferred stock, STRC.
What's so fascinating here is that all the complexity, all the long-term implications, they're entirely buried in the technical fine print. The market breathed a huge sigh of relief on the news of retention. The stock rallied hard.
Of course.
But the caveat was a structural constraint that makes the old way of doing business, the famous Bitcoin flywheel that relied on those price-insensitive passive index flows, it makes it totally impossible going forward.
So we're witnessing a forced pivot.
A forced strategic pivot, yes. From, let's call it easy common equity dilution to highly disciplined credit enhancement.
Welcome to the Deep Dive. I'm Satoshi.
And I'm Satoshi.
To truly grasp the stakes of this fight, we really have to go back and revisit Strategy, Inc.'s radical metamorphosis. For decades, they were a relatively standard, steady, but unspectacular business intelligence software firm.
Oh, absolutely. They were reliable, but not a market phenomenon by any stretch. A standard tech mid-cap for years.
Right.
The pivot, though, which began around 2020 under Michael Saylor, wasn't a gradual change. It was a radical, incredibly high conviction shift. The fundamental conclusion they reached was that global monetary expansion and inflation posed a greater long-term risk to their shareholder value than, say, competitive pressures in their own software industry.
And their response was to adopt the Bitcoin standard, which effectively transformed the company into what analysts now all call a DCO.
A digital asset treasury company. And the scale of this transformation by January 2026 is precisely the reason MSCI had to act. It's just staggering when you look at the numbers.
Lay them out for us.
By then, Strategy held approximately 673,783 Bitcoin. Their total acquisition cost for that treasury was estimated at around $50.55 billion.
$50 billion.
$50 billion. Now, contrast that with their legacy software business, their operating business, which, while profitable, was only generating about $500 million in annual revenue.
So it's a 100-to-1 ratio, basically.
It's massive. The corporate treasury, driven by Bitcoin acquisition and management, had become the overwhelming primary engine of shareholder value creation. The software side had become secondary. I mean, arguably, it was serving primarily as the legally registered operating shell for this enormous treasury.
And this is the paradigm shift that gave traditional finance, represented by the index providers, this acute headache. The foundational idea of index tracking is that value is rooted in operating earnings, cash flows, tangible production or services.
And strategy flipped that script entirely. They made the financial treasury the primary value driver, which just fundamentally challenged the core definition of what a publicly traded company is.
Which brings us directly to the indexation dilemma.
Exactly. Index providers like MSCI, they are the gatekeepers. They're responsible for indexes like the MSCI World or ACWI, which serve as the benchmarks for trillions of dollars managed by passive mutual funds, ETFs, institutional portfolios. And these providers have a strict fundamental rule. They track operating companies.
And they explicitly exclude investment vehicles.
They exclude things like ETFs or closed-end funds because they're essentially just wrappers holding other assets.
Right, to prevent double counting.
Precisely. And the reason is crucial. It's to prevent that double counting of assets. If you, as an investor, buy an S&P 500 ETF, you expect to own a piece of the 500 operating companies. If one of those 500 companies is, in turn, another ETF holding 50 other index constituents, you're unknowingly buying a secondary layer of assets. It distorts the index's integrity. It prevents it from accurately reflecting the global operating economy.
But Strategy Inc. argued, and they had a pretty compelling point, that they're not a passive fund.
And that's the crux of their defense. When Strategy holds, 85% of its enterprise value in volatile Bitcoin, it certainly looked, smelled, and often traded like a leveraged Bitcoin ETF wrapped in a software shell.
So this put MSCI in a terrible position.
Horrible position. If they included Strategy, they were exposing trillions in passive capital to extreme, highly concentrated volatility that those index mandates were just not designed to handle. It fundamentally distorted the index's representation of the operating market.
And if they excluded Strategy?
Well, then they set a dangerous precedent. Exclusion would imply active curation based on balance sheet composition, something indexes traditionally avoid. It means the index providers are taking a philosophical position on what assets are permissible.
And Strategy fought back on this. They sent that detailed 12-page letter to MSCI.
They fought back fiercely. Their argument was that exclusion would be arbitrary and discriminatory. They didn't just passively acquire Bitcoin. They argued they actively manage a complex capital structure.
Right, they're issuing debt, they're developing software.
Exactly. They're continually issuing sophisticated debt instruments, convertible notes developing software, managing yield-bearing strategies, and engaging in structured finance to optimize their asset base. They pointed to other index constituents companies like major real estate investment trusts, or utilities with massive illiquid asset bases, or even traditional gold mining operations that also hold highly concentrated, often volatile assets that dominate their balance sheets.
Their argument was, if a gold miner is an operating company because they dig gold,
we are an operating company because we finance and manage digital capital. It framed the debate perfectly for MSCI. Are you defined by your marginal revenue stream from software, or by how actively, expertly, and leveragedly you manage your $50 billion treasury?
And MSCI just couldn't ignore the sheer scale of the Bitcoin holding. It made the software business almost irrelevant to the stock's market cap.
The problem for MSCI was that Strategy was forcing them to draw a line in the sand. A line that, once drawn, could potentially ensnare dozens of other companies relying on specialized treasury practices. They needed a technical solution, something surgical, that addressed the problem without fundamentally rewriting index philosophy overnight.
And this indexation dilemma, as you said, wasn't just some academic debate. For Strategy Inc., the threat of exclusion acted as this existential regulatory sword of Damocles hanging directly over the stock.
Absolutely. Their entire business model, the Bitcoin Flywheel, it relied on the frictionless flow of capital, and that was about to be weaponized against them.
It was a quantifiable, catastrophic risk. I remember in October 2025, MSCI released its consultation paper, and it just sent shivers through the market.
It did. The proposed rule was simple, brutal, and very targeted. Any company with 50% or more of its total assets in digital currencies would be officially classified as a DATCO, a digital asset treasury company, and would be deemed ineligible for the MSCI Global Investable Market Indexes.
The index provider was basically saying, if you look too much like a crypto fund, you're out.
That's it in a nutshell. And while the consultation paper implicated around 38 or 39 smaller companies that dabbled in digital assets, let's be clear, Strategy Inc. was undecidably the whale in the crosshairs.
They were just obliterating that 50% threshold.
Vastly obliterating it. Their Bitcoin treasury often represented over 85% of their total enterprise value, depending on market volatility on any given day.
And the investment banks immediately rushed to quantify the financial magnitude of this potential exclusion. What were the numbers that created such intense market anxiety?
The JP Morgan analysts delivered the most sobering numbers. They warned that if MSCI excluded Strategy, and critically, if other major index providers like FTSE Russell and S&P followed suit, which is almost always the case,
The domino effect.
the total forced selling could reach a staggering $8.8 billion.
That's an immense figure. Just to put that in perspective for you, $8.8 billion in forced selling over a short period is more than a simple drop in the stock price. It's a structural liquidity event. It's a crisis.
It's a crisis.
Yeah.
And the direct risk from MSCI alone, that was estimated at approximately $2.8 billion in forced outflows. But it was the ripple effect, that contagious fear that the NASDAQ or the S&P would adopt a similar policy. That's what drove the intense volatility and uncertainty in the months leading up to the decision.
This fear culminated in what the media started calling the death spiral theory. We need to detail what that theoretical spiral actually looked like for the common stock MSTR.
Okay, so the theory went like this. Forced passive selling on the exclusion date would create a massive sell wall. It would just completely overwhelm active buyers and cause the stock price to plummet.
And Strategy shares always trade at a premium to the value of the Bitcoin they hold.
A significant premium, sometimes as high as 2.5 times the net asset value, or NAV. So if $8.8 billion in forced sellers hit the market all at once, that premium would instantly collapse. It would drive the MSTR price down towards its core asset value, or maybe even worse.
And if that premium collapses, the entire operational model fails. Which brings us to the crucial mechanism that necessitated this high premium, the Bitcoin flywheel, and its total reliance on passive index flows. This is how the company raised billions.
This mechanism is absolutely central to understanding the friction with MSCI. Strategy Inc.'s model is, well, it's ingenious precisely because it actively leverages its inclusion in these major indices.
So walk us through the stages of the flywheel.
Okay, so stage one, MSTR common stock trades at that premium to the NAV of the Bitcoin it holds. This premium exists because it's a unique way to get leveraged exposure to Bitcoin through the equity markets, and also because of the demand generated by the next steps.
Stage 2. Strategy initiates a continuous at-the-market offering, an ATM.
An ATM offering, right? This means they sell new shares directly into the open market, often daily or weekly, without needing a massive, single, underwritten offering. They're constantly raising capital for instant Bitcoin purchases.
Stage 3 is where MSCI comes in.
Yes. Crucially, the index provider, MSCI, tracks the number of shares, the NUS outstanding. They typically review this quarterly, but if a company issues a significant amount of shares via an ATM, the index might have to make an unscheduled adjustment to ensure their passive funds maintain tracking accuracy.
So why wasn't this continuous dilution normally so destructive to the MSTR share price? I mean, in a normal stock, if you sell billions of dollars of new shares, you crush the value per share.
Because of stage 4, passive index flows. This is the magic ingredient. When MSCI updates the NS, the passive funds that track those indexes are mathematically compelled to buy the newly issued shares to maintain their allocated weight in the index.
And this demand is...
It's price insensitive. This is the critical part. They don't care about the price. They only care about owning the exact proportion of the total outstanding shares required by the index. This guaranteed demand served as the engine oil for the flywheel. It supported the share price and absorbed billions of dollars in new equity issuance without catastrophic dilution.
So the threat of exclusion wasn't just about the stock price falling temporarily. It was about removing that guaranteed, automatic, price-insensitive buyer, the passive funds. The whole mechanism relied entirely on the index rules compelling that demand.
That's it. If the index rules said strategy is ineligible, that engine died instantly.
So the tension is just unbearable at this point. The market is pricing in the fear. MSTR common stock has underperformed for months because of this regulatory overhang. And then on January 6, 2026, MSCI delivers its verdict.
And the immediate market reaction was just relief. But we really need to deconstruct the complexity of the final decision.
The core reprieve was huge.
It was massive. Strategy Inc. would not be immediately excluded from the MSCI World, MSCI ACWI, or MSCI USA indexes. This was the headline the market wanted and needed to hear.
And what was MSCI's rationale for walking back that initial, really strict 50% threshold proposal?
They implicitly conceded that the 50% rule was just too blunt an instrument. Based on feedback from the consultation, they acknowledged that a simple asset-based threshold failed to distinguish between, say, a genuine operating company with large non-core asset holdings, like a highly capitalized REIT, and a genuine passive fund.
So they basically said, we need more time to figure this out.
Pretty much. They concluded that further, broader research into the definition of non-operating companies was needed before they could apply such a hard cutoff. And that acknowledgement, which removed the immediate $8.8 billion tail risk, was a temporary but very significant victory for strategy.
Let's quantify the immediate financial verdict from the market. We need to understand that initial euphoria.
Okay, so strategy shares had closed the day down about 4.1% because fear was still incredibly high. But upon the news release in the after-hour session, they just surged violently. They hit the $165 to $168 range, a spike of 6% to 7%.
And that was a classic relief rally.
A classic, exaggerated relief rally. It was primarily driven by short sellers who had bet on exclusion being forced to cover their positions and sideline institutional money rushing back in to capture what they perceived as certainty.
But, as we've established, that relief was only half the story. The decision was not an unqualified endorsement, it was a highly conditioned surrender. And this is where the technical details matter more than the market emotion. The critical caveat, the freeze.
This is the genius and the brutality of the ruling. Strategy survived, but MSCI implemented a surgical technical constraint that surgically severed the operational limb of that Bitcoin flywheel. MSCI announced they will not implement increases to the number of shares or NOS or inclusion factors for DECO's digital asset treasury companies.
Okay, let's dedicate a serious amount of time to this. We have to make sure you, the listener, grasp the full technical implication of freezing the number of shares for MSTR common stock.
Okay, think of the index as a perfectly weighted recipe. The weight of strategy in that index is a function of its share price times its current official index share count, the NOS.
Right.
MSCI is essentially saying, we will keep strategy in the recipe, but we are fixing the measure of flour, the number of shares at today's level, regardless of how much flour you add to the bowl later.
So if strategy issues new common shares through its ATM offering, why doesn't MSCI recognize them?
Because the index is frozen at that share count. Strategy can still sell shares into the open market, increasing the total shares outstanding the supply. But as far as the index provider's official calculation is concerned, those new shares and any subsequent share issuances, they simply do not exist for the purpose of index weighting.
The index weight stays fixed.
It stays fixed based on the share count before the January 6th decision.
This means the company can aggressively expand its float. They can increase the supply of MSTR common shares, but the passive funds tracking MSCI indices will receive a 0% buy signal, regardless of the size of the offer.
Precisely. The automatic buyer, the entire engine of the flywheel, is turned off completely. There will be zero passive buying demand generated by Strategy's future common equity capital raising activities. This eliminates that critical price-insensitive demand that supported the stock premium during those massive multi-billion-dollar dilution events.
The transmission belt of the Bitcoin flywheel.
Utterly severed. It's an elegant, almost beautiful technical containment strategy.
And this wasn't just a temporary measure, was it? MSCI also signaled this was a longer-term shift by simultaneously announcing a broader consultation on the treatment of non-operating companies generally.
Absolutely. They avoided the market chaos that an exclusion would have caused, but they simultaneously prevented strategy from dominating the index any further by leveraging that flywheel mechanism. This move signifies that MSCI is pivoting from a specific knee-jerk reaction to crypto treasuries toward building a robust, principles-based framework to permanently categorize and potentially quarantine companies that generate value primarily through treasury management rather than operating cash flow.
So it's containment, not acceptance.
Exactly. And it locks strategy into its current index size until that broader policy is finalized.
Okay, so the technical freeze is the single most important element here. If that guaranteed automatic buyer is gone, the economics of Strategy's primary funding mechanism, the MSTR Common Stock ATM program, fundamentally change. It forces an immediate and difficult strategic pivot.
The change is revolutionary. I mean, in the old model, strategy could issue billions in MSTR common equity because the mathematically mandated demand from index funds just absorbed the float expansion.
Right.
In the new frozen model, issuing MSTR common stock increases the supply overhang, but it generates zero offsetting passive demand. The company is now selling into a static demand pool, which is a completely different risk calculus.
Which means the cost of equity capital suddenly becomes much, much higher. Without that guaranteed passive floor, strategy risks dilution without the commensurate demand needed to support the share price. This puts severe pressure on the MSTR common stock premium.
The very thing that makes the Bitcoin acquisition strategy accretive in the first place.
So the conclusion is inescapable.
It is. The company is forced to dramatically slow down or maybe even halt these aggressive common stock issuance programs. They structurally cannot leverage their index inclusion for cheap capital anymore.
And this external constraint forces a pivot toward a strategy that was already quietly underway: the massive, unprecedented accumulation of a USD liquidity reserve.
This is a fascinating part of the story because it goes completely against their previous zero cash policy. Strategy's whole ethos was that fiat cash was a dissolving asset, a hot potato that must be swept into Bitcoin immediately.
And now they're holding a massive war chest, which analysts are calling the cash breakwater. What's the scale of this reserve?
The accumulation was remarkably fast and very deliberate leading up to the MSCI decision. The reserve was initially established in early December 2025 at $1.44 billion. By December 21st, subsequent filings confirmed it had expanded to $2.19 billion. By the day of the verdict on January 6th, analyst notes indicated the reserve had grown to approximately $2.25 billion in cash.
Wait, let me just push back on that for a moment. A company that is founded on the belief that fiat is dissolving value now holds $2.25 billion in cash. Doesn't that fundamentally undermine the very ethos of the Bitcoin standard they claim to champion? I mean, that smells of a contradiction.
It's a pragmatic, not a philosophical contradiction, you're right. But the company had to prioritize credit stability over rigid adherence to the Bitcoin standard, at least in the short term. They needed to establish credibility with an entirely different class of investor, and crucially, we need to ask, where did this liquidity come from?
That's the critical piece.
Why?
Who paid for this $2.25 billion reserve?
He was built almost entirely by diluting the common equity holder MSTR just before the MSCI freeze came into full effect. For instance, in the weeks leading up to the freeze, the company sold roughly 4.54 million MSTR common shares, generating $747.8 million in net proceeds, which flowed directly into this fiat cash reserve.
Wow.
This was a clear strategic internal decision. They used the last remaining moments of index-supported common equity capital to build a safety net, a guarantee specifically for the preferred shareholders.
So the accumulation of this massive reserve represented a strategic transfer of risk and priority within the capital structure. The common shareholder paid the dilution price to guarantee the preferred shareholder's future interest. The question then becomes, why hold the cash? What is the strategic, future-facing purpose of this cash breakwater?
It is the ultimate credit enhancement mechanism for the new model. Analysts estimate that Strategy Inc. needs approximately $730 million annually just to service its existing debt obligations and the rising dividend payments on its preferred stock.
And the legacy software business cash flow, about $500 million, can't cover that.
It simply cannot cover that escalating liability load reliably. So the $2.25 billion reserve acts as this massive financial guarantee sized for the most skeptical fixed income buyer you can imagine.
It's specifically sized to cover about 32 months, nearly 3 years of preferred dividend and interest payments.
Precisely. This cash breakwater successfully decouples the company's immediate credit risk from Bitcoin's day-to-day volatile price action. By pre-funding the liability payments for nearly 3 years, they transform their preferred securities, STRC, from a purely speculative equity derivative into a credit-enhanced yield product that is viable for institutional fixed income allocators, regardless of whether Bitcoin is experiencing a crash or a parabolic rise.
It's insurance. It makes the credit vehicle safe enough for institutional money to finally come to the table.
That's it.
So with the MSTR common stock ATM now impaired, structurally constrained by the MSCI freeze, Strategy Inc. needs a new engine for capital accumulation, one that is index-proof. And this is where the preferred stock, STRC, steps forward as the new priority vehicle.
STRC, Strategy's variable rate series, a perpetual stretch preferred stock, is now the company's dedicated vehicle for attracting that income-focused capital. And to make this offering competitive, attractive to skeptical institutional yield seekers, pension funds, insurance companies, corporate treasuries, strategy significantly increased the dividend rate on STRC to a very aggressive 11.00%.
That is a serious, guaranteed yield they now have to service.
It is.
But doesn't STRC suffer the same fate as MSTR common stock? Surely, if MSCI is worried about the asset base, they'd constrain the preferred stock too.
This is the critical fundamental structural advantage that makes STRC the future engine. The MSCI freeze applies specifically and only to common stock MSTR within the global equity indices. The entire purpose was to stop the common stock dilution from leveraging the equity index flow.
Okay.
Preferred stocks like STRC are not constituents of the primary MSCI equity benchmarks, nor do they feed into the capital structure tracked by most mainstream global equity funds.
They target a completely different buyer base.
A completely different universe of capital. Preferred stocks are viewed by index providers and allocators as hybrid instruments or fixed income surrogates. They are aimed at pension funds, insurance companies, and fixed income allocators who prioritize stability, yield, and predictable cash flows.
Not the volatile equity growth funds that track the MSCI world.
Exactly. Therefore, the issuance of STRC is totally unconstrained by the MSCI mandate or the common stock freeze. The freeze successfully shut down the MSTR infinite money glitch, but it left the high-yield STRC credit channel wide open for business.
And this shift aligns perfectly with the company's reframed narrative, the digital credit model. What does Michael Saylor's specific vision for 2026 look like under this new constrained framework?
He's aggressively reframing Strategy Inc. as a digital monetary institution. The thesis is simple, but it carries profound implications for risk management. Strategy acts as a sophisticated, leveraged financial institution.
A digital bank, essentially.
That's a good way to put it. It issues liabilities, the digital credit, like STRC, at an 11% fiat cost, and it invests those proceeds in digital capital Bitcoin, which is projected to yield significantly higher, maybe 20–30% or more, through long-term appreciation. The gross margin is the difference between that 11% liability cost and the Bitcoin appreciation rate.
And the $2.25 billion reserve isn't just a safety cushion. It's a necessary component to stabilize this new banking model and guarantee the institutional adoption of STRC.
It's the enhancement. It's what mitigates bank run risk and the volatility mismatch. By guaranteeing the 11% liability payments for 3 years, they transform STRC into a compelling, de-risked yield product. Institutional capital often has strict mandates that prevent investment in highly volatile assets. By separating the credit risk from the underlying Bitcoin volatility through the cash breakwater, they essentially open up a new institutional goldmine of pension funds and insurance companies that favor stability and yield over MSTR's extreme growth and volatility profile.
It's a much more mature, disciplined capital-raising structure. The pivot is clear. If the easy equity door is shut by MSCI, the company is now forced to become a sophisticated credit issuer.
And the difference in that investor base is key. MSTR attracts speculators and growth-focused equity managers. STRC targets fixed income managers who have massive amounts of capital but demand predictability. Strategy has effectively diversified its funding sources, making the company less reliant on the volatile equity premium.
And the analysts confirmed this shift immediately. They noted that the STRC mechanism provides a path to raise capital sustainably, a path that the index-constrained MSTR common stock simply cannot offer anymore. The focus shifts entirely to executing the credit narrative.
It has to.
So if we synthesize this whole complex institutional fight, the biggest, most surprising takeaway isn't just that strategy survived, but that its biggest adversary, MSCI, has inadvertently forced the company onto a structurally superior, more financially disciplined, and fundamentally more sustainable model.
It is the ultimate delicious irony of adversity. The MSCI freeze successfully eliminated the temptation and the ability to rely on massive, cheap, index-supported common stock dilution via MSTR for rapid Bitcoin acquisitions. That path, while fast and spectacular, was structurally vulnerable to the very index constraints MSCI was threatening to impose.
So this constraint, this forced deceleration of the ATM program forces, total high-conviction focus on the digital credit model on STRC as the new engine. And that requires rigor, meticulous balance sheet management, and a financial precision which, frankly, the old volatile equity model did not.
And what's most fascinating is the resulting implication for the existing MSTR common stockholder. We spent so much time detailing the fear of dilution, the constant supply overhang created by the ATM offerings, now that the index funds are no longer mathematically compelled to absorb that dilution.
The company is forced to dramatically slow down, if not halt, those aggressive common stock programs.
Which sounds like an unreserved win for the common stock shareholder. The MSTR common stock is now free from that constant supply overhang and the risk of massive continuous index-driven dilution.
It is a profound structural improvement. Less dilution means that MSTR common stock becomes a purer, cleaner, and ultimately a more leveraged play on Bitcoin appreciation, without that built-in headwind of continuous share issuance dragging down the value per share.
The stock can now move higher based solely on active demand, market sentiment, and BTC price stability.
The market has always valued strategy based on its premium to NAV. By removing the pressure to constantly increase the share count, the denominator in that equation, you stabilize the metric, which is structurally positive for the share price. The potential for long-term appreciation is suddenly much less constrained by internal corporate action.
And furthermore, that massive $2.25 billion reserve isn't just defense, it's a commitment device to the new strategy. It tells the fixed income market that the company's financial engineering focus is now entirely on servicing preferred shareholders, the liability side, which demands stability and precision, rather than relying on the volatility-fueled equity markets for constant capital injections.
It strengthens the entire balance sheet.
It does.
So, in effect, MSCI, by shutting down the easiest, cheapest, but most structurally brittle funding door force strategy to strengthen its balance sheet with fiat reserves and diversify its funding base via high-yield STRC credit products.
The adversary force strategy to accelerate its journey toward becoming a sophisticated digital monetary institution in a much more disciplined, sustainable manner than the original dilution model ever allowed.
The institutional friction of January 6 turned into a structural upgrade.
It did. The short-term pain of the MSTR freeze leads to a long-term structural gain by protecting the common shareholder from dilution and forcing the company to build a robust, credit-enhanced foundation. It's an unexpected, forced act of genius.
Which means, based on everything we've seen in the sources, that the common stock is structurally de-risked from internal dilution risk, making it a much more direct vehicle for Bitcoin exposure.
Indeed. Strategy has been forced to become a better, more robust financial institution, and that ultimately benefits the MSTR common equity holder by protecting its value from internal dilution, allowing its share price to respond more directly to asset performance.
The final analysis of the January 6, 2026 decision is a classic case of hidden complexity. Strategy survived the existential exclusion, avoiding the catastrophic liquidity event, but the cost was the total impairment of that easy common stock dilution engine.
The key nugget of knowledge here for you to take away is that the MSCI decision didn't kill the company, it gave it a heart transplant. The old heart was the passive flow of the common stock ATM, cheap, easy, but structurally fragile and dilution heavy.
And the new heart.
The new heart is the credit-enhanced, high-yield STRC vehicle backed by that $2.25 billion cash breakwater.
The freeze forces a clear strategic choice. Since the MSTR ATM is now impaired, the only viable accretive way forward is to prioritize the robust STRC model. And this sophisticated credit mechanism is capable of unlocking deeper, more sustainable institutional capital from yield-focused investors than the volatile equity markets ever could.
And for those who are long-term holders and believe in the Bitcoin standard, the constraint on MSTR common stock dilution might just be the best structural development for the common stock yet. It eliminates the constant drag on the share price and allows the stock to finally appreciate solely based on active demand and the performance of its underlying asset.
It really is the moment the company was forced to trade speed for strength. Thank you for submitting the detailed source material for this deep dive into institutional friction and strategic pivots. We hope this gave you the shortcut you needed to be well-informed on this pivotal moment in digital finance.
Until next time.
I'm Satoshi.
And I'm Satoshi.